Hi, everyone. Thanks so much for joining us here today. We're going to go ahead and get started. So as you know, we are very excited to welcome you to today's fireside chat between Michael Lyons, Managing Director of New Line Ventures and Co-Academic Director of VC Unlock Silicon Valley Online, and Ashmeet Sidana, Managing Partner and Founder at Engineering Capital. For those of you who just joined, my name is Vanessa Samaniego, and I manage operations for 500's investor education programs. We're going to be taking questions throughout the presentation. However, I really want to ask that you use the Q&A function at the bottom of the screen. That is what we'll be monitoring. Mike and Ashmeet will be presenting for about 30 minutes, and at the end of the webinar, we have slotted about 10 to 15 minutes for Q&A. Before we get to the webinar, I wanted to remind everyone about our upcoming VC Unlock Silicon Valley program in collaboration with the Stanford Center for Professional Development. We're really excited to take our celebrated investor education program virtual, and we'll be covering the same material, everything from fund formation to cap table modeling to deal flow frameworks. The program is going to be taking place this October 5th through 16th, and the final application deadline is this Friday, September 18th. We're nearly at max capacity for our course, but if you're interested in applying, I'm going to drop a link into the chat so that way you can learn more and send through an application. And of course, if you have any questions about the program, please feel free to reach out to our team at vcunlocked@500startups.com. With that said, I'd like to hand it off to Mike and Ashmeet now.
Very good. Thanks, Vanessa. And welcome everyone to one of the continuing discussions with Ashmeet Sidana, the founder of Engineering Capital. And we're talking today to the chief engineer, as he likes to say. And real quick, I'm Mike Lyons. I'm a serial entrepreneur, started a lot of companies, and been on the VC side with 5 different funds, including one I co-founded. And so I think we'll have some interesting perspectives on venture capital today that would be interesting for folks creating new funds. And we also welcome and encourage any and all questions that you may have so we can engage around them, after we stop chatting here for the next 30 minutes. So let's get started. I'm going to let Ashmeet explain kind of his path to get to this place, because it's relevant, I think, for the discussion we're going to have as we go forward. Ashmeet.
Thank you, Mike. It's a pleasure to be back at Stanford, even though we are doing it virtually. I had the luxury and privilege of studying over here, so I love coming back to school. After Stanford, I had an operating career, most recently at VMware, where I was director of product management, helped build ESX server, which of course became the killer product for the company, took it from zero to a few $1 billion in revenues. And then after VMware was sold, I've been doing venture capital ever since. I started at Foundation Capital, which is a large venture capital firm. We were managing about $2.5 billion. And I was a general partner there. And then for the last few years, managing partner, running obviously a large set of funds. And then started Engineering Capital, which is my own firm, about 5 years ago, running $140 million now under management, doing only seed stage investing, which I think represents one of the massive changes which has occurred in the venture capital landscape, the emergence of seed, the emergence of large platforms, et cetera. But we can get into that more as we get further in the conversation.
No, that's great, Ashmeet. Thanks. And maybe I'll start out with a question. So what do you see as the key trends in venture investing today, especially for emerging funds? And I know you've gone through this process in the last 5 years, and new managers are going to be looking at these trends and facing challenges. What do you see there now?
I think there's never been a better time to start a new fund, to be an emerging manager than today in venture capital. And this is really because of 2 separate reasons. One, there is an underlying explosion in the amount of opportunities which are venture backable. These opportunities are coming because of technology trends. They have nothing to do with money per se. I'm talking about things like AI and machine learning. obviously a dramatic impact on every piece of software which exists. I'm talking about the tipping point that we have reached for robotics, where we can now really create functional robots in a way that are going to change life. We've all seen the Roomba, we've been talking about autonomous cars, but we're going to see robots in many more applications. So like this, there are entire new industries being invented. And of course, this remote work, just the way we are conducting this class right now. Normally, I would be on campus, we would be sitting in a room. Here we are using technology to enable the same thing, which is going to create an enormous amount of opportunities. So one, there's true opportunity which exists, which of course, without that, you can't have venture. On the other hand, what's also happened is that venture as a business, venture as an asset class has gone through a dramatic change, partially because of the change which occurred in the technology, but because of external trends unrelated to technology. For example, regulatory pressure, the way companies go public, the amount of capital that was available, external things like interest rates, which became very low, etc. Because of that, venture capital is going through a dramatic change. And we have seen the emergence of very large platforms. I'm talking about firms like Sequoia Capital, General Catalyst, Lightspeed, etc. And we have seen specialist firms like myself at Engineering Capital, etc. And then, of course, the classic traditional firms like Benchmark, who have continued to practice, a very traditional form of venture capital, $300-400 million funds, 5-6 partners sitting in a room, working in one local environment. And all three are actually viable. I don't believe anyone is wrong or right. They are actually viable ways of investing. There are just trade-offs. There are pros and cons in how you do it. And of course, you have to practice it very differently. If you are doing the exact same work, investing in the exact same companies, if you're doing it at Sequoia, Benchmark, or Engineering Capital, you're going to do it very differently.
Well, yeah, just the fund size is going to drive very much the process internally, right? And what you need to actually create returns for LPs, that methodology is different, right?
Very much so. So fund size drives fund construction, which drives strategy at the end of the day, which is often simplified in the venture business to say your fund size is your strategy. That is certainly a truism, but I think that's oversimplification. You really have to, if you're going to practice good venture capital and run a fund, you have to take that apart and understand how and why are you doing it. Let me start with a pretty dramatic example of how we are seeing a change in the strategy and how venture gets prosecuted. And let's look a few years back to when Uber was still a private company. It was a high-flying company growing very quickly. And here we had SoftBank, which had come in out of left field, raised a tremendous amount of money, $100 billion, unheard of amount for a venture capital fund, the first Vision Fund. And they were investing in all sorts of companies. And of course, they also invested in Uber, most famously. Now, if you ignore all the drama that occurred, between the lawsuits, the CEO changes, et cetera, that was happening, let's just study that transaction when SoftBank became an investor in Uber. And that very same transaction, it was a complicated one. Like I said, there was a lot of drama about control, CEO, board rights, et cetera. But just take the money side of it. And in that very same transaction, what people don't notice because of all that drama is that we had Sequoia Capital buy stock and Benchmark sell stock in that exact same transaction at two different prices on the same day at the same time in the same company. Arguably two very good firms practicing a very different strategy and a very different form of venture capital. And this is the ultimate living proof: buy and sell on the same day.
And things you would never have seen 20 years earlier.
And this was inconceivable. 20 years ago, I was not a practicing venture capitalist at that time, but that's what I would call the traditional or the classical style of venture capital, which I now describe as life cycle venture capital, by which I mean that what happened in those days is that a company would make an investment, let's call it a Series A. It would not be a large amount of capital, maybe $2, $3, $4 million was a classic Series A. And they would then become the anchor investor in that company, typically the largest owner with disproportionate control, including a board, including voting rights, et cetera, which was not as extreme as a private equity firm, But implicitly they had a tremendous amount of control on that company. And then they would stay the largest owner through the entire life cycle of that company up to the IPO or the M&A exit for that.
Right.
That was classical venture capital. If you want to dig deeper in this, you can actually Google. I gave an interview to Fortune magazine, and I described exactly this change which is occurring in venture capital, where this life cycle model was dead. And this was being replaced by a stage specific model. In other words, firms will specialize in stages of company formation, and then they will invest according to that stage. And again, Uber is a great example of that, where you had Sequoia coming in, Benchmark leaving, and of course, SoftBank, et cetera, involved in that very same transaction, because the stage of that company had changed, even though it was not an exit in the sense of an M&A or an IPO in a classical sense that occurred over there. So this has been a tremendous change, and this has, of course, resulted in a change in the way we organize firms. It has resulted in the size of the funds, in the way fund construction is done. Every aspect of venture capital changed because of the change in this life cycle. We have seen things which were unheard of, like the emergence of solo capitalists. In other words, firms like myself, where I'm the only general partner, I'm the only partner in the firm practicing it just as an individual. And of course, there are many other firms which are now solo capitalists. By the way, a trend that I believe we will see more of. And then we have seen platform firms, firms raising $1 billion, $2 billion funds, venture capital funds, even if you ignore SoftBank, which is clearly an outlier. It's not unusual to have $1 billion fund and have it be a venture capital fund, or make $100 million investment as a venture capital round in a company.
Sure. Looks more like a private equity firm in some ways.
That's really interesting that you bring up private equity, because I do believe that we are seeing a long-term trend where private equity and venture capital will come closer and closer to each other. And at some point may also become the next stage of a venture capital company. Traditionally, what happened, you formed a company, there was some innovative, very high risk phase, venture capital came in, usually funded that part. Then there was a growth phase for the company, which was also basically the end of venture capital. Public equities came in, the company became public, and went through hopefully a long growth phase. If you look at Amazon or look at Microsoft or look at Cisco, right? They all went public in the hundreds of millions of dollar market cap, not hundreds of millions of dollars raised,
Right.
Hundreds of millions of dollars market cap, and then created billions, hundreds of billions, $1 trillion of market cap in the growth phase. And then were taken over companies, not in those particular cases, but typically when companies' growth slowed, they were taken over by a private equity firm. Now what's happening is that private equity phase is coming closer and closer, and the venture capital phase is going longer and longer, and eventually they may meet, which is kind of what happened again in Uber,
Right.
where SoftBank, I believe, was behaving more like a private equity fund than like a venture fund when they did that transaction at Uber. But regardless, even if you ignore Uber, which is clearly an outlier in so many levels, I do believe we will see private equity firms coming earlier and earlier, and venture capital firms going later and later. And therefore, there will be some fuzzy middle where there will be a blurring of those definitions.
This is very exciting times right now, because there's a lot of dynamics going on in these markets. Let me switch gears here just a little bit and go on to the investment decision side a little bit, because certainly new funds are going to have to make a lot of decisions on how they invest and what are they looking for and those sorts of things, and try and tie that back into their investment thesis. But let me ask you a quick question. If we're doing an early stage investment and you're looking at a company, how important is their initial demonstration of product market fit? Is that a big deal or not so important?
Different people have different opinions. I personally believe product market fit is all or nothing. In other words, there is a phase for a company when you start till you achieve product market fit. At that point, it is all about getting to product market fit, figuring out how you get there, being incredibly frugal, not spending capital. It's all about learning, spending an enormous amount of time with customers, rapid iteration, etc. Once you have product market fit, it's all about scale. How fast can you grow? How quickly can you expand your processes? How efficient can you be? Not how frugal can you be, but how efficient can you be in how quickly you scale once you get to product market fit. So that is really the one key focus point of investing in the venture capital ecosystem. Are you before product market fit, when you are arguably a seed or a Series A company? Or are you post product market fit when you are really trying to grow and scale very quickly? So it all pivots on that one point of, do you truly have product market fit? However, I would be remiss if we didn't have a discussion on product market fit, if I didn't also say that while all depends on getting to this product market fit is not permanent. Product market fit changes all the time because the market changes all the time, the environment changes all the time, what's happening around you changes all the time. All the companies that had product market fit before COVID, completely different after COVID, because the market had changed dramatically. Nothing changed about the company. Their product was the same, their features were the same, the technology was the same, but the world had changed. And that's why we saw, for example, an explosion in the use of Zoom, an explosion in the use of grocery delivery. And on the other side, we saw retail completely atrophy because of the impact of COVID. So even if you thought you had product market fit, or if as a company or an investor, you think you have product market fit today, you may not have it tomorrow, or you may have it tomorrow. And that's what makes investing so fun.
Oh yeah, I completely agree with you, because the underlying dynamics can shift the game very, very quickly, which is just what we saw with COVID. And I think those trends, as many have pointed out, aren't going away. And things will
No,
be.
these trends are not going away, Mike. And, COVID is such a dramatic example because it was a worldwide pandemic. Let me give a couple of more examples which also had a similar type of impact, but perhaps people don't pay as much attention to them. One example would be the ImageNet competition, where for the first time we saw a neural net look at an image and do image recognition. And there was a quantum leap when Jeff Hinton presented his paper. And that's really the emergence of AI and ML. Till then, AI and ML was a backwater. It was one of those academic pursuits that, a couple of professors did, and they wrote some papers. And every year the ImageNet competition, went up by 0.1%, 0.2%. That's it. And then one day Jeff Hinton walks in, presents a paper, and boom, 20% improvement in image recognition. Unheard of, absolutely unheard of. And that, of course, is the start of the AI and ML revolution that we have over here today. So these revolutions can be quiet. They can be subtle. Today, it's obvious, it's kind of slamming you in the face that AI/ML is going to change the world. Most people were not even aware that, ImageNet had gone through this massive transition when it actually happened. And these types of things are happening every day in smaller, quieter ways. And our job as venture capitalist investors is to go find them. We have to go look for them, find them, and then fund them.
Well said. So another a question that would frequently come up, I think, in selecting investments and deciding when to invest in them and what stage and so on, is when you're doing seed investments, how important is doing a priced round versus, say, just doing a safe note or something like that, where your equity conversion is going to happen later?
Yeah, this is a topic that's near and dear to my heart because I have lived through the pain of having seen the emergence of safe notes and the abuse of safe notes. Look, a safe note is just a legal instrument. It's a document, obviously, in this case, crafted by YC originally, which has become very popular. And it's quick, it's easy, and therefore very popular. Unfortunately, I don't think it's a good instrument. And when I say it's not a good instrument, I mean both for the investor and for the company. It's not a good instrument. In other words, it's not like it's one versus the other. It's really not a win-win instrument. Let me give a simple example. A safe note, almost by definition, has some notion of a valuation cap in it.
Yes.
And that cap may have a discount, may not have a discount. Maybe you're converting into the next round. But when you make an investment on a safe note, you are fundamentally misaligned with your company. In other words, it is in your interest as an investor for the price to stay low for the next round. So you should quote unquote hurt your company is better for you as an investor when you invest in a safe note or an instrument like that.
Which
What
is
a terrible dynamic.
that's crazy, right?
What a terrible dynamic it sets up. And I haven't even gotten into some of the legal issues which come up with it. But just in terms of the fundamental misalignment that occurs when you invest in a safe note versus doing a priced round. The second thing which I would say is people often disdain price rounds because they are expensive. The lawyers make it complicated. It can take some more time, effort, etc. That's no longer true. You can do a price round very quickly now, for example, using standard open source documents like seriesseed.com, Cooligo. These are open source price round documents, which are very, very simple. You can literally fill in a few blanks, very similar to filling out a safe note, and get a round closed, within a day or 2 or 3. And if you're not willing to wait a day or two, and if the founder is not willing to wait a day or two, that's not a venture investment. There's something weird going on in that dynamic. If you really are going to make an investment for the next 5, 7, 10 years and build a large company. So I am a huge proponent of priced rounds. I think that little bit of effort that it takes to set up the right structure gets you aligned with your founder. It answers a few critical legal questions like who is your board member? What is the charter? What are the voting rights? Which really should be answered before you enter into an investment rather than punting all the questions down the road on a safe note. And then, these things can come home to roost and really bite you in a very, very difficult way.
Yeah, I completely agree with that. And in fact, one of the things we've been teaching at Stanford for years in the entrepreneurship programs and in outside starting a lot of companies is one thing that entrepreneurs frequently don't pay enough attention to is corporate governance and getting things set up right, having the right legal structures and so on, and then having to repair all that stuff later is really messy.
Yeah, I mean, the analogy is, the legal documents, the structure that you're setting up, that's really the foundation of the company and the business that you're going to build. And the question I ask people is, are you building a foundation for $1 million, $100 million, or $1 billion, or $10 billion? Clearly, you would build a different foundation if that's the type of company that you wanted to build. Just like the taller the building, the deeper the foundation, you have to think carefully about what structure you're setting up.
Totally agree. So one last question, and I think we can shift to Q&A. What's your take on investing in B2B versus B2C deals? Are there advantages either way, or is the investment strategy different, or how do you look at that?
B2B and B2C companies have both been very successful areas for venture capital investment. So they are certainly compatible with putting in a small amount of capital, getting very high growth rates and very high returns. However, the way you practice the craft of venture capital is very different in these two types of businesses. You have to evaluate them differently. Their capital needs are different. Their growth curves are different. Their governance and management is different. And so in many ways, they really are two different businesses from the eyes of a venture capitalist. And that's why you see today pretty much a specialization where even within, either there are firms which are entirely devoted to one or the other. And even within firms which are larger, which want to do both, they will have partners who are dedicated to B2C or dedicated to B2B investing. Because like I said, they're really very different businesses. And why are they so different? Let's take a look at a couple of factors. So in B2C, it's all about traction. It's all about how fast can you get new people onto your platform, how can you grow, etc. And then it's a question of how do you monetize it. There are well-known ways to monetize it, whether it's subscription, whether it's advertising, etc. And so really people look at that through the lens of traction. That becomes the one focal point through which you evaluate B2C companies. Whether you're a very early stage investor, you're betting on what's going to come, or you are a later stage consumer investor doing B2C investing, and you can look at those charts and what the cohort is, what the retention rate is, what the LTV rate is, etc., and look at it through that lens. But it always comes down to one word, which is traction. B2B, on the other side, is much broader and diverse in the way businesses work. It could be traction. There are B2B businesses that are based on that, but that's not the dominant case. B2B is often dominated by direct selling, enterprise sales, perhaps much deeper use of technologies, much greater risk,
Mm.
longer sales cycles. So it's a very different flavor of company that is being built, very different type of business that's being built. And that's why it's evaluated very differently from venture capital. The partners are different. The businesses themselves become very different when you evaluate a B2B company. In fact, I will go so far as to say that Silicon Valley really consists of two different islands, because even the employees who join these companies are different, right? The VP of marketing of a B2B company is very different from the VP of marketing from a B2C company. The VP of sales is different. The VP of engineering is different. So they're just very different ecosystems that you look at between these two. And so even though they are both compatible with venture capital, and you could make a 10x, 50x, 100x on your money, and we have lots of examples on both sides, they really are different businesses from the view of a venture capitalist.
Yeah, and it seems to me also, at least in my experience, that the general partners are in the funds, need specialized experience in these kinds of companies to make proper investment decisions. In other words, somebody that does B2B businesses all the time is going to struggle with a B2C investment just because they lack that experience.
Very much so. I mean, there are exceptions. I mean, I can, name partners who I think are very interesting individuals who have made amazing B2B and amazing B2C investments. I mean, like, for example, I'll call out my friend Jim Getz over at Sequoia, right? He did
Right.
Palo Alto Networks, classic deep tech B2B investment. He did WhatsApp, classic B2C investment, right? So
Right.
it's the same person, same partner, same firm. Making two very different styles of investments. But that is really a credit and a testimony to Jim Getz's venture capital investment skills. You have to recognize that the business itself is completely different, so different that most partners are actually specialists in either B2C or B2B.
Very good. So I think, Vanessa, we're going to try and deal with the Q&A part of this now and see what folks would like to talk about.
Wonderful. Thank you again for both of you for sharing all your insights now. Let me take a look at a few questions. That way we can kick off this Q&A portion. So to start off, we have a question. How saturated should a venture be in the market before a VC will determine market fit?
What a great question, which is, how strong does the signal have to be? How well do you have to know that you have product market fit? The answer to that question is perhaps framed with the following question. How many trees do you have to see to call it a forest? In other words, there is no simple answer to your question. It is in the eye of the beholder. Is one tree a forest? Clearly not. Is a million trees a forest? Obviously, yes. And at some point, a clump of trees becomes a forest. And different investors, depending on what stage they are at, will evaluate product market fit based on that. So for example, someone like me who is a seed investor, even a pre-seed investor, in fact, I am the first investor in all my companies, I'm looking for, quote, product market fit in a very tenuous, very rough, very simple way where I'm able to call some of my friends and say, if we built this and if it had these features, do you think you would get a benefit out of it? Do you think there's a customer for you? And if enough of my friends tell me yes, I consider that product market fit for me to make an investment. Most people would not consider that product market fit. For a Series A, product market fit might be defined as, in a B2B company, maybe defined as something like 3 to 5 customers, a few $100,000 in revenues, maybe maybe $1 million in revenue these days. That would be considered, that's definitely initial signs of product market fit and a pipeline developing over there. And on the backs of that, you could probably raise in today's market, 8, 10, $15 million in a very nice Series A if you were able to demonstrate a high growth rate on a product behind that. So that's one way of evaluating it. On the consumer side, of course, it's a much more continuous function. When you evaluate a company like Spotify or Facebook or any sort of consumer company, they all had one subscriber on the first day, and then two, and then three, and then five, and they just grow sort of incrementally from there. And there you really are looking at the slope of the curve, and at what rate are they able to grow, what the virality is, what is the retention, what is the number of times people come back, etc. But again, what you're trying to evaluate is a continuum over for both B2B and B2B and B2C businesses over a long period of time, and different people will make different judgments along that continuum.
Yeah, and in certain rather narrow markets, I'll use airport security as one of them. In that market, when we built those systems, actually only one customer defined product market fit, which is very unusual, right? But in that particular one, it was the Israeli Ministry of Defense. And that was actually the only customer that mattered. And as soon as you have that one, you have the whole market. And so, but those are very strange situations, but they do exist from time to time. There's an influencer there that you have to get to say you have product market fit.
That's a great example, Mike. And you, of course, built a fabulous company there. So congratulations again. And, post 9/11, it was such an interesting opportunity to be able to go in and help the whole world become more secure in terms of airport security. That really, and Israel, of course, being a leader in, given the environment that they work in and live in over there, being such a leader and so well recognized, was such an important customer to build that business. But I would add to that and say that from the perspective of a venture capital investor, especially in these growth markets today, there are, in these later stage growth rounds, there is still the notion of how much can you scale? Are you able to increase your manufacturing? Can you bring more capital in? Because now, we are doing, quote, venture capital rounds, of $100 million at a later stage of a company. And so if you really take the broad, long arc of where you are on that cycle, you can still call it a venture capital investment after you've got that product market fit.
No, absolutely right. Vanessa.
Thank you. Yeah, we'll move on to the next question. Do you find yourself challenging over-optimistic pre-money valuations, and do you see this as an issue?
Very much so, especially in today's market. From an entrepreneurs will often have this simplistic view that a high valuation is better. So the first thing which I try to explain to them is valuation is not a number. Most entrepreneurs think valuation is a number. It's not a number. A valuation is a package deal. It includes a number, of course, but it also includes a set of terms. It is a package deal that includes a particular investor, the investor's reputation, the investor's style, the investor's approach, the investor's expectations for the future, and, like I said, a set of legal terms which come with those. In fact, in venture capital, one of my mentors and former partner, Bill, he had this wonderful way of saying, I'll give you whatever valuation number you want, as long as I get to write the terms. In other words, he was happy to give you a high number if he was able to write the terms. So the first thing to understand on valuation is it's not a number. Some entrepreneurs, like I said, they simplistically think it's a number. And again, YC has unfortunately contributed to this problem by creating the SAFE, which, it puts all the focus on that single number, which is, yes, again, very dangerous to look at the world that way. But
completely agree.
Right. But for better or for worse, entrepreneurs will make the simplistic assumption. But if you can explain to them that it's a package deal and you're getting this entire package that you are buying when you're specifying, a valuation, in other words, a term sheet or an investment that you're making, then you can begin to make trade-offs, pros and cons, and say, well, I might take a lower valuation if you structured the board this way, or if there were the liquidation preferences were set up this way, or if a drag-along right was set up in a different way. And so that's really, really, really important for an entrepreneur to understand, and frankly, for a practicing venture capitalist to understand. That said, at the end of the day, our job as investors is to make an investment. Once we find someone who we believe is a 10x entrepreneur, out of the box, someone who's going to change the world, is going to be disruptive, then we have to work, we are a service industry. We have to serve them, and we have to find an opportunity that meets their needs. which could include a high valuation, even if it is not quote unquote prudent in the sense of what I may recommend. At the end of the day, they're driving the bus, and great entrepreneurs have choices. And so we have to work around that. As long as I believe that you can make a high return, in other words, the multiple, where of course the valuation is the one number that matters the most, is going to be high, everything else has to serve that need.
Wonderful. Thank you. Next question. In your understanding and experience, what are the 3 key factors you look for when reading an investment memo?
Yeah, so just like valuation is a package deal, an investment decision is also a package deal, right? It's all or nothing. At the end of the day, you're either going to invest or not, but you got to look at the team, you got to look at the market, you got to look at the financials, you've got to look at what the gross margin will be, you've got to look at the valuation. At what price are you going to get into this deal that you are evaluating? So you have to look at all of them. That said, the 2 most important things, in my opinion, are number one, the team. There is no substitute for an amazing team. There would be no Tesla without Elon Musk. There would be no Apple without Steve Jobs. There would be no Facebook without Mark Zuckerberg. People like that are very, very important. So number one, it's team. It's very subjective. It's controversial. But at the end of the day, we are evaluating the team. And number 2, it's the market. The reason I say it's the market is because a rising tide lifts all boats. And if an entrepreneur is able to find a market which has favorable dynamics, that will help everything else along the way. Is it a big market? Is it going through a phase of disruptive change? Is it a market where the customers are willing to pay high prices? Is it a market where technology can be leveraged disproportionately to benefit from? Does it have network effects in that market? All of these are factors that you would look at when you study the market. And so I think once you've got team and market nailed, pretty much everything else you can, whiff on and make some mistakes on and still be a great venture investor if you get those 2 things right. So that's really where I start when I look at an opportunity: team and market.
And I would add that one of the things that the great team allows you to do, of course, once you have the market, is to actually dial in product market fit, because because the team is capable of doing that, and that's one of the reasons why team strength is so important, because you could have a great market and the wrong team, and they'd never achieve product market fit.
Absolutely right. You cannot win without a great team, and you cannot win in a terrible market.
Yeah.
Perfect. We still have a few more minutes, so I'm going to go through a few more questions. One person here is curious how you think about investment in regulated industries such as healthcare, and if you see COVID as an inflection point that can change the landscape.
So it has been proven now that venture capital can succeed in highly regulated environments also. In other words, there is an opportunity in certain special cases to make venture capital style returns in regulated markets. However, that's a very different business. Healthcare is, of course, one example, but Mike earlier had a different example where literally the government was the only customer, or very large regulated industries were the only customers for these security machines for scanning at the airport. And yet they were able to make venture style returns, build a great business in that market. So it can certainly be achieved. So let's first start with that observation. Is it possible? Yes, it's possible. However, because it's a regulated market, the dynamics are very different. You have to study the market very differently. You have to approach it very differently as an investor. And I'll bring up a very controversial aspect of investing in regulated markets. An unfair advantage in regulated markets, including healthcare, is political influence. What is the political landscape? How do you evaluate the future political direction? And so that is an aspect that is traditionally not considered in Silicon Valley style venture investing in, for example, a B2B SaaS company, or perhaps even a consumer company. But in regulated industry, that's a much bigger factor. So you have to evaluate those companies differently, but it can be achieved. And yes, COVID is going to have a dramatic impact. Like any great disruption has a dramatic impact on the opportunities for venture capital. Anytime there's the disruption, startups have an advantage. When there's no change, when there's no disruption, it's very difficult for startups. The incumbents tend to grab those advantages, and then it's very difficult to wrestle it away from them. But when there's a disruption, wow, that's when the opportunity for entrepreneurs and venture capital comes in. And so, yes, there are going to be literally tens, perhaps hundreds of multi-billion-dollar companies created, which will trace their roots to the disruption of COVID. Zoom was not created because of COVID, but Zoom has clearly benefited enormously from COVID.
Yes.
But then many more companies will be created because of the changes which have occurred because of COVID. Look at us sitting over here today. We are doing this remotely over Zoom. This is a permanent step function change which has occurred in the world. I do believe we will go back to offices one day. I do believe we will be sitting in our classrooms again, hopefully in a year or so, once we've got a vaccine and we've kind of solved this problem. But it's never going to be exactly the same as it was before. There is going to be a step function change. We will do much more work remotely. The very nature of organizing companies, of organizing universities, of organizing the government is going to change. And that is going to create opportunities for startups. Right as we speak right now, there are people who are brainstorming ideas, who are experimenting with technologies, who are leveraging ways and things to use in a way that in 5 years will be obvious. We will go and say, of course, that was the right time and the right way to leverage the disruption caused by COVID.
Yeah, completely agree. And we one of our portfolio companies, we were hiring some new engineers the other day, and somebody asked, well, where does that person live? And the response was Zoom. What difference does it make where they live? And,
what a great answer. What a great answer.
It's on Zoom. So, it's no architecture, but, that's the location. Yeah. Vanessa.
Perfect. Let's do one more. I think we have time for that. How do you think VC can drive value and create high return opportunities in emerging markets where there are structural challenges?
Yes. So we have to recognize that venture capital has thrived in Silicon Valley, earlier in Boston, Austin, because we had a tremendously developed market and special advantages here in the US, which allowed this very nascent, very special form of investing to succeed. That, of course, is now a global trend. We have seen venture capital investing do extremely well in China. We've seen some of it in Israel, some of it in India, but not a tremendous amount in other places. That is because venture capital is a very delicate flower. It can only survive in very special environments. And so it's pretty hard for it to happen. That said, overall, I am an optimist. I do believe that we will see venture capital investing in emerging markets. We will see more of it, and we will see it slowly grow into a larger and larger fraction of the ecosystem in every market that exists in the world. I'm very happy to share with you that the very first venture capital investment I personally made in India, in fact, the only investment I ever made in India, was a company called Azure Power. That company went all the way to IPO. It's a public company in the New York Stock Exchange. It's worth, $1.5 billion or something today, over $1 billion. And that was a pure emerging market investment. The company was formed in India. It started in India. Its business was in India. And today it's a public company on the New York Stock Exchange. So it's definitely possible. It's definitely you will see many more of these. And so broadly speaking, the trend is in that direction.
Wonderful. Thank you so much. So I think we're out of time, but thank you again, Ashmeet. Thank you, Mike, for taking the time today and answering questions from the audience. We're going to be sending out a recording of the webinar to everyone who registered today. So if you missed something, you're going to be able to rewatch it at your own time. And finally, if you have any questions about the program, feel free to reach out to our admissions team here at BC Unlocked at 500startups.com. Thank you again, everyone. Have a great rest of your day.
Thanks to everyone.
Thank you.
And thanks, Ashmeet.
Thank you, Mike. Thank you, Vanessa.